Good day. My name is Siphiwe Mqadi. I'm an academic at the School of Accounting, Economics and Finance here at the University of KwaZulu-Natal in the discipline of auditing. Today we'll be looking at the examination preparatory workshop for your grade 12 accounting paper 1. So we'll be looking at your September examination paper. We'll start, there's 3 questions there, various other things to look at, a lot of pointers that I'll be giving on an ongoing basis. So if you may just pay due diligence and take notes wherever you can so that you can go back and refer to those notes as they will help you quite dearly. All right, this paper was written in 2020. It's a September paper 1 question. Ideally, you would want to have that paper very handy so that you can have easy reference as and when I move along with the presentation. The question consisted, or the paper consisted of 3 questions. The first question emphasized cash flow statements and notes. Question 2 looked at your balance sheet, notes and interpretation as well. And then question 3 looked at notes and interpretation. Now, contrary to popular belief, there's quite a lot of interpretation, as you would see in this paper, because most people think that accounting is all about number crunching. And that is an accounting of the olden days. In today's day, you need to be able to analyze, advise management or shareholders and so forth, give you insights on the information that is being presented, either being your annual financial statements. So there is a considerate amount of interpretation that needs to go in there. Theory as well, you need to be fond of that, not just only the calculation. All right, so that you can have a due balance in as far as the entire question paper is concerned. All right, your first question basically starts off by easing you in with the multiple choice sort of like questions where they've given you various answers on top over there, and there are questions that are being asked and you need to plug in the correct answer. It's more theory based, however, it's marks that you do not want to miss, as it's an addition to you having to score higher marks in your examination. Now, an increase in creditors will indicate A or N. If you look at your cash flow statement, this is how you're supposed to look at it. If you look at the cash flow statement, it all considers cash, the outflow and the inflow of cash into the business. It doesn't look at what has been incurred or the occurrence, as your financial statements normally look at that holistically. Here, we're looking at an increase in creditors. It means that we have been extended more and more credit. So that has a favorable effect into our cash flow. So it means that is an inflow in cash. The next question, the shareholders' equity added to non-current liability is referred to as. That means that you are using your capital, therefore it's capital that has been employed by the business. And is regarded as a non-cash item. If you look at the top there is only one non-cash item that is glaring at you, that is depreciation. Depreciation, it means that it's a loss in value of an asset. There is no necessarily cash that is flowing out of the business. We are not paying anything for that depreciation, or rather for that loss in value of our assets. However, it is treated as an expense, obviously, in your income statement, but it is a non-cash item. An increase in trading stock will indicate AON. If you buy inventories, as I've just started my sentence, if you buy inventory. So what that means is you have taken money in the business and you've given somebody that money because you wanted inventories from them. So that is a cash outflow from your business. Okay, so that was a quick, easy theory questions that eased us into your paper. I hope you now are quite settled, because now we're getting into a more challenging part where there's a bit of more calculations from your side. So when we look at now the calculation part of things of this question, that is your cash flow statement, the first thing that is required from us is to prepare an ordinary share capital note. Now, these are notes that you will find in your financial statements. It is a note. You need to know how to prepare the note right from the beginning. Obviously, you would have been provided with the answer book, where you will page through and they will show you exactly what is it that you need to do to fill in everything and answer this question adequately. Okay, the information is presented to you. I always like to suggest that you read the entire question so that you can absorb and start making notes to yourself to say, okay, this will affect which part of the cash flow statement, and start making notes, write in your question paper and say, that is my operating expenses or activities, that is my investing activities, that will affect my financing activities. It makes the job a little bit much more easier when you have to now refer back, because there's quite a lot of pages that you may have to page through. The information is very lengthy. All right. The information that is presented to you is that, A, you've got the extract from your income statement on 30 June 2020. Now, before you start doing anything, there's one thing that is very, very, very important that I do want you to always start writing. That is your accounting period, the period under review. What the accounting period normally is 12 months. Here you are presented with the information for the year ended 30 June 2020. It means it's the 1st of July 2019 up until 30 June 2020. That is your accounting period. You're also presented with the extract from the balance sheet on 30 June, and you've got under C, information related to the issuing of shares or anything that's got to do with shares, dividends, fixed assets, and your financial indicators, which are obviously your ratios. Okay, now the first information there requires you to prepare the shareholders, or rather the ordinary share capital. The first thing that you need to look at is, what is my authorized share capital? You've got 2 million authorized share. Now, these are the shares that you are authorized to issue as a company. They are not being issued, they have not all been issued. Just means that you are authorized as that company to issue up to that amount of shares. Okay? Now, the next thing that you will realize is that all the information that is pertinent, pertaining to shares sits right there under C. So you've got your authorized share capital of 2 million ordinary shares. However, on 30 June 2019, you had 1.2 million ordinary shares that had been issued. So that would be your starting point on your ordinary share capital. You want to know what is the balance of our shares that we have already issued. Then the next bullet looks at the shares that now we have repurchased, meaning that a company has decided to repurchase the shares that it had previously sold to shareholders. Companies do that. We will unpack why do they do that, the benefits of why they do that as we go along. On 30 June 2020, all shares that were unissued as at 30 June 2019 were now issued. So you can see from the 3 last bullets there that it shows us that 1.2 million shares have been issued, And that is depicted also in our balance of ordinary share capital, which is 4.2 million rands. Now the issued shares, that's just the number of shares that have been issued, and the 4.2 million, that's the amount in there. Also, you will know that in 2020, we've got a closing balance of ordinary share capital. It means that in the period under review, that is the balance now of all the shares that have been issued thus far, and that is 7.6 million rand. Now, when you go back, you take your 4.2 million and you divide it by the number of shares. That will give you how much per share or how much did we issue those shares. So each share we sold for 3.50 Rand. Now the next bullet that we looked at is the company then decided to say, look, we want to buy some of our shares back from the shareholders that we previously sold shares to. And these were repurchased at 4.10 Rand per share. Now this transaction is 2 in 1. If you can just maybe follow me. The first part of this transaction comes from the ordinary share capital. So we've got an ordinary share capital. I've provided a buyback of shares table over there, and it explicitly plugs every other calculation that you may need. For example, the first calculation is the 40,000 ordinary share capital of 140,000 Rand. Now that is at that 3.50 Rand. That's the normal price that we would have sold those shares to the existing shareholders that we want to buy the shares back from. And then the next thing that comes from there is you will see that we are now buying these shares at 4.10 Rand, which is 60 cents above the amount that we would have sold that share to initially. The initial amount was 3.50 Rand, and now we're buying these shares back at 4.10 Rand. So it is an increase in the share price that we are paying of 60 cents. Now that portion needs to come from our retained earnings. We will understand that businesses have got retained earnings. They keep money for various reasons. It could be expansion, it could be the buying of fixed assets, opening another branch and so forth. So that money is what we call a retained income. They retain that amount. So the excess amount needs to come from there. And that is the 40,000 shares at 60 cents, which is 24,000 Rand. Now, the final figure, which is our balancing figure, as per our ordinary share, our retained ordinary share capital note, that is now the number of shares that we were able to issue in the current year. And that is, we were able to issue 800,000 shares at 4.48 cents. That is a balancing figure because you already have your opening balance. You already have your shares which we've repurchased. You have your closing balance of your ordinary share capital. Now the missing figure or the information is silent on what is the number of shares that we've issued at what value. They're just merely saying on 30 June 2020, all shares that were unissued as at 30 June 2019 in the previous accounting period were then subsequently all were issued, and that will be our balancing figure. Question 1.2.2 requires you to prepare the statement of cash flow as at 30 June 2020. Now that carries the bulk of the marks. That's where you will relatively want to spend more of your time, because whenever you're writing an accounting paper, time management is crucial. And time management at some point requires you to weigh in your options to say, look, I am going to jump to this question because it carries most of the marks, or I'm going to jump to this question because it's one that I'm, very fond of. I understand what cash flow is all about. I've studied it quite at length, and I'm comfortable with it. So time management has got a lot that you need to consider in as far as time is concerned, especially in an accounting paper, because they normally say, we never finish an accounting paper, and that's just the part of it. All right, it's 32 marks that you're looking at. Now here, a cash flow, first of all, it shows how changes in the balance sheet accounts and income affect cash and cash equivalent. And it then breaks down all of these effects and analyzes it down to operating, investing, and financing. There are 3 sections that you will have to look in, make sure that you cover if you have to prepare the entire cash flow statement, unless you are specifically required to prepare a certain section, for example, the operating section or the investing section or the financing section. All right, so in this case, we need to prepare all 3 sections. Now, your starting point for your of your cash flow statement is your operating activities. These are the activities, how we have used cash in the business to operate this business. We are all looking at physical cash that has been paid and that has also been received by the business. First and foremost, our information that is presented to us from the extract of the income statement is that we had an interest on loan of 82,000 that we have paid. That is obviously for your operations, and it is an outflow in cash, so you need to clearly identify or depict that outflow in cash by putting it in brackets. Normally learners and students make mistake in a sense where they just write in the amount. It is also equally important to indicate that this is an outflow or it is a negative amount and put it in a bracket. So that outflow of the interest that we've paid of 82,000, it's simple and straightforward, no calculations needed there. Then the next thing is you look at your income tax. Now, ideally, there's 2 ways in which you can do this. You can look at the information that is given to you and basically do the calculations in your head, with a huge risk, obviously, of maybe that you might miss something or get it wrong. So, would say get a piece of paper, just write your ledger account, put your SARS income tax account in your general ledger. Draw in your T account, put in your balance of 8,000 over there. Then the next thing that you need to do, you've got your closing balance of 12,500. Your closing balance of 12,500 is obviously the balance that has been carried down, and it's on the credit side because this is normally an amount that you would have to owe, that you owe to SARS, which means that you have to pay SARS. You are a creditor to SARS. Hence, it has a credit balance. Now, the income tax of 75,600, that would have been the amount that a business would normally, during the course of the year, before they get their assessment from SARS, or rather their final assessment from SARS, to say, this is the amount that you owe us. We have assessed you. You owe us this amount for the current period. Companies would normally, therefore, make payments during the year, and they would say, okay, we will pay X amount in this quarter or half yearly and so forth, just to reduce their tax burden instead of having to pay the whole amount as and when SARS then comes up and gives them the assessment. That is the amount that we are interested in. What have we then paid? So SARS has come in and they've given us an assessment, and they're saying that income tax assessment is 75,600. So now we have a opening debit balance, meaning SARS was owing us. We were not owing SARS. It is on the debit side. It means now that SARS was owing us. However, the closing balance is on the credit side. That means we have paid 55,100 rand during the course of the year. That is an outflow, obviously, of cash. And you then, therefore, need to go and put that in there on your taxation that we have paid thus far. And that is 55,100 rand. And then the next thing that we're going to look at are how much of dividends have we paid to our shareholders. We'll understand that your shareholders are owners of the business, and as owners of the business, they have put in money into this business, and we need to reward them for putting money into the business. And how they get their reward is through dividends. They don't get a salary like management, people working within the company, they only get dividends. So now we want to look at how much of dividends have we paid in the current year. All right. Again, I've made it very simple there. Draw your T account. It makes life exponentially easy for you. You've got your balance of shareholders' dividends of 210,000. You've got your closing balance of 174,000. Now you have two types of dividends. You've got your interim dividend. If you go back to your question paper, your interim dividend would be the one that we, under D, the interim dividend of 20 cents per share was paid at 31st December 2019. So again, they declared that dividend and they paid it at that point in time. And that's what we're looking for. Now, there's two ways of doing this. Again, if you don't want to use your T account just like I have, you can logically think this through and say, okay, there is a balance of 210, which comes from the previous year. Now, they cannot pay interim dividends in the current year if they haven't paid the final declared dividends in the previous year. So it means they would have paid those dividends that were declared but not yet paid in 2019, and then inclusive of the interim dividends that we are paying out. Those two amounts make out your cash outflow for paying of dividends. It's just those two amounts. If you want to do the T account, you'll then do your T accounts, the opening balance, the dividends declared and paid, the closing balance of dividends, and then the final amount, CPJ, cash payments journal. We've paid dividends of 450,000 rand. Whichever way works for you, whichever way is faster, whichever way will relatively make you not to make more mistakes or miss figures. Hence, I say that having a T account makes me see what is it that I'm doing instead of working it up in my head. Okay, then the next thing that we need to look at are our fixed assets. Now, our fixed assets, whenever you are in a business, you will buy assets, you may want to sell assets. There's also assets that depreciate. All of that needs to be taken into account to arrive to figures on how much of assets have we bought, how much of assets have we sold. Now, the information which relates to fixed assets under E, it says an old vehicle was sold at its book value or at its carrying amount of 23,500 rand during the financial period. Now, that instruction alone tells you that we sold a vehicle for 23,500. That is an immediate cash injection into the business, or rather a cash inflow into the business. So you will then need to go under your investing activities and indicate the fact that we sold a vehicle, and we sold that vehicle for 20 or whatever the asset is. We sold it for 23,500 rand and we received money, and it needs to show positively, not in brackets, that it is a cash inflow. Okay, then now when you want to find out, because they're also silent on the or how much of fixed assets have we then purchased during the year. They're just saying additional fixed assets were purchased during the financial period. It means you need to physically calculate how much of fixed assets have we purchased during the year. It's pretty easy. Again, have your T account. You have your balance of fixed assets at the beginning of the year. That is the 1.2 million. And then you'll have your closing balance. Both balances are on the debit side because it is an asset. Assets have the effect of, they are debited because they increase rather on the debit side as per your accounting principle. But the closing balance was first a balance that was carried down in the current financial period. Then you plug in the assets that you have disposed. Because it is an asset account, your accounting principle dictates that if an asset decreases, it will decrease on the credit side. Therefore, you will have to credit the asset disposal of 23,500 rand. Then the next thing that goes in there is that loss in value of assets, which is depreciation of 61,000. Again, it is a loss in the asset, and the asset is, as per your accounting principle, decreases on the credit side. So you credit your fixed assets with the depreciation amount. Then the next thing that will be left off there is to take all the figures on your credit side and deduct the balance, the opening balance, to give you now the amount of assets that we've purchased during the period, and that is 388,400 rand. Now that would be an outflow in your cash because you've purchased those assets. That will have a negative effect on your cash flow, and it needs to be shown clearly in brackets that it was a cash outflow. And then when we look at now your investing activities, the first one that we look at is your fixed deposit. A fixed deposit, that is when you have taken money and you've decided to go invest it somewhere else. It could be a bank. You put it in there for a certain amount of time so that you can earn interest from that amount. Now, it is fixed, meaning the period in which you will have to put it in there or you will have to invest is clearly stipulated and communicated to you. So you know exactly that I'm putting it for a year, 5 years, 10 years, or whatever the case may be. Now, the balance of your fixed deposit here is sitting at 185,000, meaning we already have fixed deposits to the value of 185,000. Now, when we look at the closing balance, our closing balance all of a sudden in the current year is sitting at 195,000. It is already clear that during the accounting period, we made some investments towards the fixed deposit account. And it's just a matter of deducting the closing balance from the opening balance. And therefore, we have taken money from the business and we've invested it. And when you invest, again, as you can see with my hand, when you invest, you are putting something. I am the business, I'm taking it from my business and I'm investing it. So it's a cash outflow and you will need to indicate it as such. Then The next thing that you will have to do now is to complete the cash flow statement. Is you look at your financing activities. Now, your financing activities, it's all those things, it's all those amounts or what the activities that you have done to finance this business, to make sure that it is running, it is everything that we need within this business. We are able to either acquire it because we have enough cash and so forth. So there is a loan that we've taken out. The loan balance obviously is sitting on the credit side because this is an amount that you as the business will owe to third parties or other stakeholders. They gave you the money. It is sitting on the credit side because you are now a creditor to those stakeholders. And then from the 560,000 at the beginning of the year, you will see that now at the end of the current year, our balance is sitting at 400,000. Now that clearly again states that we have decided to pay a portion of the loans that we owe from 560 to 400,000. So you can see the decrease in there. Now, it is a decrease in loan. It means that we've taken money from the business and we've decided to say, okay, let's settle X amount of loans. And that's the amount that we need. The bank amount of 160,000 rand. That needs to also go to your a cash flow from financing activities. Now, last but not least, we'll bring back your ordinary share capital. And that now will tell us, will actually give us all the other pertinent information. Information like the number of shares that have been issued and so forth. And all of that is depicted. You'll need to show that in your financing activities. For example, there were sale of shares in the current year of 3.5 million. All right, 3,584,000. The 3,584,000 was your balancing figure from our ordinary share capital to find out how much of the shares have we issued. Now, when you issue shares, they buy shares from you. So when somebody buys something, you are getting the money. Hence, it is depicted as a positive effect in your cash, in your statement of cash flows. The next thing that the company did was they decided to buy back some of the shares that they had previously issued. When they buy back some of the shares that they previously issued, it means we are taking money from the business to buy those shares. And when we do that, it is a clear outflow in cash from the business. So there were 40,000 shares that we bought back from our shareholders, and we spent 4.10 rand per share. So you multiply the 40,000, multiply it by the 4.10 rand. That is the value, the price per share, and that is 164,000. It's a negative, obviously, on your investing activities because it decreases your cash in the business. Okay, so again, what I would like to reiterate from this section is I really want you to go back and study further that buyback table because it makes life relatively easy. It gives you all the calculations that you need, or your ordinary share capital, your retained income amount that we used to buy those shares, and obviously the bank amount, which is the total amount that we've taken out to buy those shares. Moreover, when you're dealing with a statement of cash flows, I do recommend that when you're looking at all the effects per account, just fall back to your general ledger. That will help you quite very dearly because you've got your general ledger right in a rough piece of paper, and you can put all the debits on the side that they belong in, and all the credits, and then you can balance that account very well to find out all the missing figures that you may need. All right, so the final will then bring you to your statement of cash flows. You've got your cash generated from operations, you've got your cash flow from investing activities, you've got your cash flow from financing activities. Now, you take all those three sections to then find out what is the net change in cash and cash equivalent. So you would have totaled each and every section. If it is positive, for example, your cash generated from operation is 639,100 Rand, which is positive. Your cash flow from investing activities is a negative of 374,900. And then your cash flow from financing activities is a positive of 3,260,000 Rand. You just calculate it as normal to find the net change in cash and cash equivalent. Then, the next thing is, what is our opening cash and cash equivalent, or rather your cash and cash equivalent at the beginning of this period? That looks at your bank. So you have to look at your cash and cash equivalent, your bank amounts, as you can see in this exercise, there is a bank overdraft. So we have a cash and cash equivalent, which is a favorable at 2,000 Rand. However, we have a bank overdraft of 17,100 Rand. A bank overdraft, it means that the bank allowed us to withdraw money over and above the actual money that we have in the bank. It's a line of credit that banks use. So with 17,100 Rand, being a bank overdraft and having a favorable cash and cash equivalent of 2,000 Rand, you need to just deduct the 2,000 Rand to find out what's the opening, or rather the cash and cash equivalent at the beginning of the year, and that's 15,100 Rand. And the next thing that you do is now you calculate as normal the cash and cash equivalent at the end of the period, which is 2,922,000. Now, that cash and cash equivalent at the end of the year is normally a point of where people realize whether they've done something wrong, because from the extract in the balance sheet, it is given the cash and cash equivalent at the end that it's 2,922,000. If you don't get that amount, it means that you would have gone wrong somewhere. Again, fall back to time management. Do I have time to then go and diagnose what is wrong in my cash flow statement? If you don't have time, really my advice is just move on, because that mark alone of 2,922,000, it's just a one mark that you may want to live without, instead of wasting more time trying to then diagnose the entire statement of cash flows. All right, now 1.2.3, then they're asking the cash flow statement reflects some important decision taken by the directors. Now, directors are part of management. They run organizations on behalf of shareholders. They make pertinent decisions on daily basis. They are there in a business on every day of the week, making sure that the day-to-day running of the business as per the wishes of the shareholders and the board and so forth are taken forward. Now, the question further on says, apart from the dividends, identify 2 good decisions and explain the effect of each decision on a company. So you are not allowed to make any suggestions relating to dividends. They just want any other good decisions that have been taken by directors other than dividends. Now, the first one is they have purchased fixed assets. We've calculated that. they've purchased fixed assets to the value of 388,400 rand. One person would say, how is that a good decision? Because it improves operating efficiency so that you as a business would be in a position to earn greater profits. Whenever you buy a vehicle, it may be used in the delivery of your inventory to your customers. Your customers are going to come in, they will order inventory, and they know that you've got a delivery service, meaning you can deliver now this inventory to them. Again, that's greater profits that are coming into the business. You can fall back to your asset definition and say, an asset is a resource which has been acquired as a result of past events from where future economic benefit is expected to flow into the business. Though there's a cash outflow, but we are expecting that these fixed assets will generate greater profits for us. The next thing is they've issued shares. Now this improves cash flow because shareholders come into the business and they buy shares. When they buy, they give the company money, and that means that it improves the various opportunities within the business because now the company has money. Also, we then repurchased some of the shares. Now, with having to repurchase or buy back those shares, it comes with various other benefits. The first one is it improves the net asset value, which could impact positively on the market price of shares. Now, the net asset value basically means that the business is doing quite very well, and they are able to buy shares, they are liquid, they have excess cash available to buy back shares from shareholders should the need arise. It improves the dividend per share, hence present shareholders will be satisfied. Now that means is that when they buy the shares, the dividends that is being paid out to existing shareholders will also be expanded in a sense that the shareholders will get relatively more now because there are less hands to go by in as far as the payment of dividends is concerned. Improve the earnings per share, which creates better image of the company. If the company is able to buy its shares, the earnings per share is improved because prospective investors are able to say, oh, wait a minute, they do have money. And then when you calculate your earnings per share, it will relatively be more without having to grow the business. But you know, there's all these advantages or these benefits that come with having to buy back the share. Also, we've repaid some of the loan. You know yourself that if you take out a loan, you have a present obligation to then at some point in time repay that loan. Now, if you repay the loan as per the stipulations, if you are an individual person, there's what we call a credit bureau where they calculate your credit score to say you are paying your accounts or you are paying your creditors in time. You know, you're not letting them to go over. Same thing goes with the business. They have to maintain a low financial risk, or they are low geared because they are able to pay off their loans. Now 1.2.4, it wants us to calculate the following ratios. There's two ratios. The first one is the net asset value per share. Now, you will ideally be provided at the back of your question paper with your ratios. You can refer to those. However, in most cases, they don't explicitly say this is the net asset value. They just give you the ratio. So you will need to be in a position to identify and say, okay, this is the current ratio. This is the asset test ratio. This is a net asset value ratio. So having that knowledge to identify the ratio in your question paper, even though it's given to you, will also help you quite dearly. So for a net asset value, all we need is your ordinary shareholders' equity that we have already obviously calculated using our ordinary share capital of 7,683,200. And then the next thing is you need the number of shares issued thus far. You will remember that we had 1.2 million shares issued. Then we issued other shares during the year. Now, and then the closing balance of shares was sitting, now the number of shares, not the amount, the number of shares. It was sitting at 1,960,000. So we've issued 1,960,000 as a business, and our net asset value is 392 cents. Then the next one is the return on average shareholders' equity. Again, refer to your formula sheet at the back of your question paper. The return on average of shareholders' equity, that is net income after tax divided by the average shareholders' equity. Now, the net income after tax is not explicitly given again, but they've given you the net profit before tax, and they've given you the tax amount. You just have to calculate the net income after tax. What do? You take your net profit before tax and you just deduct the tax amount of 75,600. And then obviously the average shareholders' equity. Your shareholders' equity is given in the extract from the balance sheet, account number 3. You've got 4,495,400 in 2019, and then you've got 7,683,200 in 2020. We just need the average of the two. You add the two and then you divide it by 2, which gives you 2.9% or 3%. And then I think this is the last question on your question 1. It says the directors are pleased that the operating efficiency of the business has improved. Quote and explain 2 financial indicators to support their opinion. Again, 4 marks, easy marks. It basically just needs you to apply your mind and be in a position to then draw back to the theory that you would have studied in as far as the analysis of financial statements is concerned. The first one that we will look at is the percentage operating expenses on sale has decreased from 39.2 to 31.5. That clearly means that management were able to effectively control their expenses. In any business setting, you want to have more income and less expenses so that you can have that net profit increasing, and then your shareholders will be happy as on your efforts as management. So here, the operating expenses on sales, this is the operating expenses in relation to the sales that we have made. They have decreased from 39.2% to 31.5%. The next one is the operating profit on sales. How much profits have we made? Now, when you talk about profits, you want those to increase. When you talk about expenses, you want those to decrease. Now, operating profit on sale has increased from 6.5% to 12.7%. Another effective control of expenses and a higher markup percentage. It may be because they've increased the markup percentages of the inventories or whatever that the business is selling. Okay, that was question 1, cash flow statements. Stay tuned tomorrow. We'll be dealing with the balance sheet, notes to the balance sheet, and also interpretations. Stay tuned for that.